Hi, this is Richard Campo from Rose Capital Partners. I'm putting this video together to talk through the role that critical illness cover plays when looking to take out a mortgage. So in this video I'll talk through the three main topics, which are firstly, what is critical illness cover? Secondly, why you might need it? And then thirdly, what type of cover and what amount should you get? Now this sits very squarely in one of our core principles of the business, which is working with our clients from the moment they first get in contact with us to the moment in which they're mortgage free. Now, in an ideal scenario, that would be a case of we'll spook you for a few years, rearrange your mortgage and save you as much money as possible until you're completely mortgage free. Now, unfortunately, I've done this long enough to know that life gets in the way and sometimes that doesn't go as smoothly as you'd hope. A mortgage by its very nature is a very long-term commitment. It can be anywhere between 20, 25, 40 years in some cases. So during that period of time, things can happen that can derail you. So why we're very passionate about this is we never want our clients to be financially disadvantaged for those sorts of events. And this is exactly why critical illness cover is so important. So to that very first point of what critical illness cover is, it was created back in 1983 by a guy called Dr. Marius Barnard. He was a South African cardiac surgeon. Now he was a very, very intelligent man because he didn't just see the way that medical science was going. What he also then saw was the impact of what was happening to his patients. So he was increasingly getting his clients to survive surgery that previously they wouldn't have done. But then that was only sort of half of the problem, because once they survived the surgery, what some of them were then going on to was experiencing a lifetime of financial difficulty, because maybe the surgery is very expensive, or maybe they built up debts or mortgage arrears during the period at which they're getting treatment. And he felt very passionately it shouldn't be that way. So he linked up with a number of insurers to create what is now known as critical illness cover. So what it does by definition is paying out a lump sum of money to you on diagnosis of a predetermined critical illness. Now if you roll that forward to today, and the way it works specifically in the UK, is a critical illness policy has to cover 22 core conditions as described by the ABI, which is the Association of British Insurers. So any insurer has to fit that definition in order to offer this contract. Now I'm not going to go through all 22 because some of them are less relevant than others. There's 4 I just want to pick out, because to most insurers this takes up about 80-85% of all claims, and this will cover things like cancer, heart attack, stroke and multiple sclerosis. In fact, cancer makes up more than half of all claims, so it shows you just how important that is. Now what some insurers do is offer extra benefits, cover more conditions, or make their policy maybe sort of more complex in order to stand out. The very extreme of that is Vitality, who cover I think currently about 182 conditions. So there's quite a lot of complication in the market, but that's why I try and drill it down to those 4 key areas, because that's what you're most likely to experience. And we look at companies that have great payout records, and we'll look after you in that way. Now the second point is, why do you need the cover? If you've seen anything to do with Stand Up to Cancer, which I think is absolutely brilliant, you'll know the stat, which is 1 in 2 people will get cancer before they die. Sorry to be so sort of bleak about that, but that's just the truth. And that goes back to why I just went through the definition of Marius Barnard, because this is the way it's going to go. More illnesses are going to be picked up, but the good news is more will be treatable, but it does mean you may have to live with the condition or survive for a very long time afterwards. What was really interesting actually is that Legal & General, one of the leading insurers in the world actually, do some research annually called Deadline to Breadline, and please do look it up. And they think on average most families in the UK would last for 24 days before their income runs out. So that would be a classic, I'll go back to the cancer example, is if you're off having chemo, maybe you can't work, what happens when your sick pay expires? What happens if the treatment you want isn't available on the NHS? You've got to think about what you'd want to happen in this situation. I would hope that most people would want the financial freedom to get the best treatment or the best time to recover and not have to force themselves back to work, because that really does debilitate your recovery. So the way I've always thought about it is money gives you freedom, and it gives you choices. And equally the opposite is true. Most people are quite resourceful and can probably get through, but it might mean selling a property or having financial difficulties. Surely you wouldn't want that in an ideal scenario. So this is why this is just so important. So that takes me to the third point then of what type of cover is needed and how much. Now this is where it gets a bit more complex, so I'm not going to go through this in detail, but I'm just going to talk through the high level principles of things you need to think about. So the only sort of bit of technical talk I do is just now. So the main ways you can set the cover up is what's called a level term insurance or a decreasing term insurance. Now, the level policy is typically linked with an interest-only mortgage, the decreasing typically with a repayment mortgage. If you have a part and part mortgage, then you can do sort of 2 policies to cover the relevant parts of the mortgage. Now, the reality is that's quite expensive. So I've gone through the stats as to why. It's very highly likely you'll claim on this. So you've got to think about then, if you can't afford to cover the entire mortgage, how much cover would you need? Now, another good benchmark if you can't afford the full mortgage cover is to think about your annual salary. Would you need 1 or 2 or 3 years cover? So how long would you need? Also, you don't need to factor in tax as well. So you might sort of think, well, actually, if I have 2 years worth of my gross annual salary, that might last you 5 years, if that sort of maths. And then in most situations, that would cover you for the eventualities we're talking about. Now, the exact amount of cover and how it's structured will be very dependent on you and your circumstances, and primarily your budget as well. So that's why I think independent advice is just so important, so we can talk you through these aspects and help you. Now, ultimately, you're an adult and you'll make your own decisions. You can roll the dice, absolutely fine. You might have family that can help you. You might have great benefits through work. That might be the case. But for many, many people, that isn't the case. So I would urge you just to think about this for a moment. Think about if it were to happen, what impact that might have on you. And surely that's worth a very modest sum of money to cover this eventuality. Our role as an advisor is simply to make you aware of this. As I say, you'll make your own decisions to do what's best for you. But we think it's very, very important you make an informed decision. And if you want to go down this path, we'll help you and advise you and make sure you get the best possible outcome.